Darby here, the UK's favourite property tax accountant. So today I'm just going to run through a question which came up in a WhatsApp group that a property tax and accounting WhatsApp group that I run. And essentially it's kind of what issues are there when you're loaning money from one limited company to another. Does it have to be repaid back within 9 months? Does it get caught within the director's loan account? Overdrawn tax implications? I'm going to run through all of that quickly and give you the information you need to know. So broadly, when you're making a loan from your trading limited company, so if you've got a limited company that's got cash in it, it's cash flow, and you looking to loan that to an investment company in order to buy a property, from a tax perspective, that's absolutely fine. So you can do so without any tax issues at all. So you've got £50,000 in company A, you can loan that to £50,000 to company B, no tax issues. And if they're both UK resident, there's no real requirement to charge an interest rate, because I've not seen it where HMRC are bothered, because you're not changing the amount of tax that's owed, you're simply moving it from one company. So if you were to charge interest, you'd be charging interest in one company, tax deductible in the other company. The HMRC and the revenue, they've not lost out on any tax revenue, so there's nothing for them to really go after. It does change a bit if you are using an overseas company, and there's a potential for some tax revenue to be lost out on, so bear that in mind. Or if one company's got losses and essentially the amount of tax you're paying is lower than it otherwise would have been, then maybe look to charge an interest rate. But if it's all above board, you're not saving any tax, because one company's charging interest, the other is tax deductible. Overall, it's all equals out. Absolutely fine, no reason to charge interest, and these loans can remain indefinitely. One thing to bear in mind though is that those loans must be repaid back at some point if you're looking to sell the company, wind the company down, or if you've got other creditors and you're looking to close the company down. That loan could be pulled back from the other company, which might force you to raise additional funds, sell some properties in your investment company. So doing intercompany loans from company A to company B is not the most resilient structure, because those loans have to be repaid, or they can be written off, which might create a tax charge in one company, a tax loss in the other, and could potentially put you out of pocket some tax. So if you are looking at doing this regularly, moving money from company A to company B and so on, maybe look at having a group structure in place, because this will be much more beneficial and allow you to move funds around as dividends to your holding company and then loan it back down from there, so you remove the risk of the trading business and having to repay those loans. That's all for today, guys. I hope this helps. Any questions at all, pop them in the comments, send me a message. I'll be more than happy to help. Cheers for watching.